Hello and welcome. In this course, we will explore investment property based on International Accounting Standard 40. IAS 40 investment property was adopted by the International Accounting Standards Board in April 2001. This standard had originally been issued a year earlier in April 2000 by the International Accounting Standards Committee. It replaced certain parts of the older standard IAS 25 accounting for investments, which had been published in March 1986 and which had not already been replaced by IAS 39 financial instruments recognition and measurement. Later, in December 2003, the board issued a revised version of IAS 40 as part of its initial technical project agenda. Further amendments were made in January 2016 through IFRS 16 leases, which expanded the scope of IAS 40 to include not only owned investment property, but also investment property held by a lessee as a right-of-use asset. Several other standards have introduced minor consequential amendments to IAS 40 over time. These include IFRS 13 fair value measurement issued in May 2011. The annual improvements to IFRS's 2011-2013 cycle issued in December 2013, IFRS 15. Revenue from contracts with customers issued in May 2014. The amendments related to agriculture, bearer plants affecting IAS 16 and IAS 41 issued in June 2014, IFRS 17, insurance contracts issued in May 2017, and the amendments to references to the conceptual framework in IFRS standards issued in March 2018. Additionally, in December 2016, the board issued transfers of investment property, which amends IAS 40 by clarifying when a property should be transferred to or from investment property. International Accounting Standard 40, which deals with investment property, consists of 86 paragraphs. Each paragraph holds equal authority and maintains the original format established by the International Accounting Standards Committee when the standard was later adopted by the IASB. To fully understand and apply IAS 40, it should be considered in the context of its stated objective, the IASB's basis for conclusions, the preface to IFRS standards, and the conceptual framework for financial reporting. In situations where the standard does not provide specific guidance, IAS 8 accounting policies changes in accounting estimates and errors serves as a reference for selecting and applying appropriate accounting policies. The objective of the standard is to establish how investment properties should be accounted for, along with the related disclosure requirements that entities need to follow. This standard applies to the recognition, measurement, and disclosure of investment property. However, it does not apply to biological assets that are related to agricultural activity, nor does it apply to mineral rights and mineral reserves, including oil, natural gas, and other similar non-regenerative resources. This standard uses specific terms with defined meanings. The carrying amount refers to the value at which an asset is recognized in the statement of financial position. Cost represents the amount of cash or cash equivalents paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction. Where applicable, it may also refer to the amount attributed to the asset when it is initially recognized in accordance with the specific requirements of other IFRS standards, such as IFRS 2 share-based payment. Fair value refers to the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Investment property is defined as property, whether land, a building, a portion of a building, or a combination of these, held by the owner or the lessee as a right-of-use asset for the purpose of earning rentals, capital appreciation, or both. It is not held for use in the production or supply of goods or services for administrative purposes or for sale in the ordinary course of business. In contrast, owner-occupied property is property held by the owner or the lessee as a right-of-use asset for use in the production or supply of goods or services or for administrative purposes. Investment property is held to earn rentals, for capital appreciation, or for both, and it generates cash flows largely independently of the other assets held by an entity. This characteristic sets it apart from owner-occupied property, where the production or supply of goods or services, or the use of property for administrative purposes, results in cash flows that depend not only on the property itself, but also on other assets involved in the process. Owned owner-occupied property falls under the scope of IAS 16, while owner-occupied property held by a lessee as a right-of-use asset is addressed by IFRS 16 leases. Examples of investment property include land that is held for long-term capital appreciation rather than for short-term sale in the ordinary course of business, as well as land held for a currently undetermined future use. If an entity has not yet decided whether the land will be used as owner-occupied property or sold in the short term, it is considered to be held for capital appreciation. Other examples include a building owned by the entity or a right-of-use asset related to a building that is leased out under one or more operating leases, a vacant building that is held with the intention of being leased out, and property that is currently under construction or development for future use as investment property. Examples of items that are not classified as investment property and thus fall outside the scope of this standard include property intended for sale in the ordinary course of business or property under construction or development for such sale. This also covers property acquired solely with the intention of being sold in the near future or developed for resale. Owner-occupied property is another example, including property held for future use as owner-occupied, property intended for future development, and subsequent use as owner-occupied, property occupied by employees, whether or not they pay rent at market rates, and owner-occupied property awaiting disposal. Additionally, property that is leased to another entity under a finance lease is not considered investment property. Some properties consist of a portion that is held to earn rentals or for capital appreciation, and another portion that is used for the production or supply of goods or services or for administrative purposes. If these portions can be sold separately or leased out under a finance lease, the entity accounts for them separately. If the portions cannot be sold separately, the property is considered investment property only if an insignificant portion is used for the production or supply of goods or services or for administrative purposes. In some cases, an entity provides ancillary services to the occupants of a property it holds. If these services are insignificant to the overall arrangement, the property is treated as investment property. An example of this would be when the owner of an office building provides services such as security and maintenance to the lessees occupying the building. In some cases, the services provided are significant. For instance, if an entity owns and manages a hotel, the services offered to guests are crucial to the arrangement as a whole. Therefore, an owner-managed hotel is classified as owner-occupied property, not as investment property. It can be challenging to determine whether ancillary services are significant enough to exclude a property from qualifying as investment property. For example, in the case of a hotel, the owner may transfer some responsibilities to third parties through a management contract. These contracts can vary greatly. In some cases, the owner may act as a passive investor, while in others, the owner might outsource daily operations, but still retain significant exposure to the variation in the cash flows generated by the hotel's operations. Judgment is required to determine whether a property qualifies as investment property. An entity should develop criteria to ensure that this judgment is applied consistently, in line with the definition of investment property and the related guidance provided in the relevant sections. If classification is difficult, the entity is required to disclose the criteria used to make this determination. Judgment is also needed to determine whether the acquisition of investment property should be treated as the acquisition of an asset or a group of assets or as a business combination under IFRS 3 business combinations. To determine if it qualifies as a business combination, reference should be made to IFRS 3. The guidance in paragraph 714 of this standard addresses whether property is classified as owner-occupied or investment property, but does not deal with determining if the acquisition of property constitutes a business combination as defined in IFRS 3. To assess whether a specific transaction meets the definition of a business combination and includes an investment property, both IFRS 3 and this standard must be applied separately. In some cases, an entity may own property that is leased to and occupied by its parent or another subsidiary. In the consolidated financial statements, the property does not qualify as investment property because it is considered owner-occupied from the group's perspective. However, from the perspective of the entity that owns the property, it is classified as investment property if it meets the definition provided in paragraph 5. As a result, the lessor treats the property as investment property in its individual financial statements. An owned investment property should be recognized as an asset only when it is probable that the future economic benefits associated with the investment property will flow to the entity and when the cost of the investment property can be measured reliably. Under this recognition principle, an entity evaluates all its investment property costs at the time they are incurred. These costs include those incurred initially to acquire an investment property, as well as those incurred later to add to, replace part of, or service the property. According to the recognition principle in paragraph 16, an entity does not include the costs of day-to-day servicing of an investment property in its carrying amount. Instead, these costs are recognized in profit or loss as they are incurred. Day-to-day servicing costs typically include labor, consumables, and may also cover minor parts. These expenditures are often described as costs for repairs and maintenance of the property. Parts of investment properties may be acquired through replacement. For instance, the interior walls could be replacements for the original ones. Under the recognition principle, an entity recognizes in the carrying amount of an investment property the cost of replacing part of an existing investment property when the cost is incurred, provided the recognition criteria are met. The carrying amount of the replaced parts is derecognized in line with the derecognition provisions of this standard. An investment property held by a lessee as a right-of-use asset should be recognized in accordance with IFRS 16. An owned investment property should be initially measured at its cost. This cost includes transaction costs, which are part of the initial measurement. The total cost of a purchased investment property consists of the purchase price and any directly attributable expenditures. Examples of these expenditures include professional fees for legal services, property transfer taxes, and other transaction costs. The cost of an investment property is not increased by certain expenses. These include startup costs unless they are necessary to bring the property into a condition that allows it to operate as intended by management. Additionally, operating losses incurred before the property reaches the planned level of occupancy and abnormal amounts of wasted materials, labor, or other resources during construction or development are not included in the cost. If payment for an investment property is deferred, its cost is considered the cash price equivalent, and the difference between the deferred payment amount and the total payments is recognized as interest expense over the credit period. When one or more investment properties are acquired in exchange for a non-monetary asset, or a combination of monetary and non-monetary assets, the cost of the investment property is generally measured at fair value. This applies to exchanges of non-monetary assets, but also to other similar exchanges. However, this measurement at fair value does not apply if the exchange transaction lacks commercial substance or the fair value of neither the asset received nor the asset given up is reliably measurable. In cases where the asset is not measured at fair value, the cost is determined based on the carrying amount of the asset given up. An entity determines whether an exchange transaction has commercial substance by assessing the extent to which the transaction is expected to change its future cash flows. An exchange transaction is considered to have commercial substance if the configuration, risk, timing, and amount of the cash flows of the asset received differs from the configuration of the cash flows of the asset transferred, or the entity-specific value of the portion of the entity's operations affected by the transaction changes as a result of the exchange, and the difference in A or B is significant relative to the fair value of the assets exchanged. For determining whether an exchange transaction has commercial substance, the entity-specific value of the portion of the entity's operations affected by the transaction should reflect post-tax cash flows. In many cases, the result of these analyses may be clear without requiring detailed calculations. The fair value of an asset is considered reliably measurable if the variability in the range of reasonable fair value measurements is not significant for that asset, or the probabilities of the various estimates within the range can be reasonably assessed and used when measuring fair value. If the entity can reliably measure the fair value of either the asset received or the asset given up, the fair value of the asset given up is used to measure cost, unless the fair value of the asset received is more clearly evident. An investment property held by a lessee as a right-of-use asset shall be measured initially at its cost in accordance with IFRS 16. Measurement after recognition. With the exception noted in paragraph 32A, an entity must choose between the fair value model, outlined in paragraphs 33, 55, or the cost model, outlined in paragraph 56, as its accounting policy. This policy must be consistently applied to all of its investment property. According to IAS 8 accounting policies, changes in accounting estimates and errors, a voluntary change in accounting policy should only be made if it results in the financial statements providing more reliable and relevant information about the effects of transactions, other events, or conditions on the entity's financial position, performance, or cash flows. It is highly unlikely that a change from the fair value model to the cost model would result in a more relevant presentation. This standard requires all entities to measure the fair value of investment property, either for measurement purposes, if the fair value model is used, or for disclosure purposes, if the cost model is used. While it is encouraged, it is not mandatory for an entity to measure the fair value of investment property based on a valuation by an independent valuer. However, the valuer must hold a recognized professional qualification and have recent experience in the location and category of the investment property being valued. An entity has the option to choose either the fair value model or the cost model for all investment property backing liabilities that pay a return linked directly to the fair value of or returns from specified assets, including that investment property. Choose either the fair value model or the cost model for all other investment property, irrespective of the choice made in the first option. Some entities manage investment funds either internally or externally. These funds provide investors with benefits determined by the units they hold in the fund. Similarly, some entities issue insurance contracts with direct participation features, where the underlying items include investment property. For these purposes, insurance contracts also include investment contracts with discretionary participation features. Now, it's important to note that an entity is not allowed to measure property held by the fund, or property that's an underlying item, partly at cost and partly at fair value. If an entity chooses different models for these two categories, any sale of investment property between pools using different models must be recognized at fair value. The cumulative change in fair value is recorded in profit or loss. So, if an investment property is sold from a pool using the fair value model to a pool using the cost model, its fair value at the time of sale becomes its new cost. The fair value model requires that after initial recognition, an entity measure all of its investment property at fair value, unless there are exceptions outlined in paragraph 53. Any gain or loss resulting from a change in the fair value of investment property must be recognized in profit or loss for the period in which the change occurs. When measuring the fair value of investment property according to IFRS 13, the entity must ensure the fair value reflects factors like rental income from current leases, as well as assumptions that market participants would use under current market conditions. Additionally, if a lessee is using the fair value model to measure an investment property held as a right-of-use asset, it is the right-of-use asset, not the underlying property, that should be measured at fair value. After initial recognition, an entity that chooses the fair value model must measure all its investment property at fair value, except in certain cases. A gain or loss arising from a change in the fair value of investment property must be recognized in profit or loss for the period in which it arises. When measuring the fair value of investment property in accordance with IFRS 13, the entity must ensure that the fair value reflects rental income from current leases and other assumptions that market participants would use when pricing investment property under current market conditions. When a lessee uses the fair value model to measure an investment property held as a right-of-use asset, the lessee must measure the right-of-use asset and not the underlying property at fair value. IFRS 16 specifies the basis for the initial recognition of the cost of an investment property held by a lessee as a right-of-use asset. The investment property held by a lessee as a right-of-use asset must be remeasured to fair value if the entity chooses the fair value model. When lease payments are at market rates, the fair value of an investment property held by a lessee as a right-of-use asset at acquisition, net of all expected lease payments, should be zero. Therefore, remeasuring a right-of-use asset from cost to fair value should not result in any initial gain or loss unless fair value is measured at different times, which can occur if the election to apply the fair value model is made after initial recognition. In exceptional cases, when an entity first acquires an investment property, or when an existing property first becomes investment property after a change in use, there may be clear evidence that the variability in the range of reasonable fair value measurements is so great and the probabilities of the various outcomes so difficult to assess that a single measure of fair value is not useful. This could indicate that the fair value of the property will not be reliably measurable on an ongoing basis. When determining the carrying amount of investment property under the fair value model, an entity should not double count assets or liabilities that are recognized as separate items. For instance, equipment such as lifts or air conditioning systems, which are often integral to a building, is generally included in the fair value of the investment property rather than being recognized separately as property, plant, and equipment. Similarly, when an office is leased on a furnished basis, the fair value of the office typically includes the fair value of the furniture because the rental income is related to the furnished office. In such cases, the entity does not recognize the furniture as a separate asset. Additionally, the fair value of investment property excludes prepaid or accrued operating lease income, as these are recognized as separate assets or liabilities. The fair value of investment property held by a lessee as a right-of-use asset reflects expected cash flows, including variable lease payments that are expected to become payable. Therefore, if a property valuation is net of all expected payments, it will be necessary to add back any recognized lease liability in order to determine the carrying amount of the investment property using the fair value model. In certain situations, an entity may anticipate that the present value of its payments related to an investment property, excluding payments related to recognized liabilities, will exceed the present value of the associated cash receipts. In such cases, the entity applies IAS 37 provisions, contingent liabilities, and contingent assets to determine whether a liability should be recognized and, if so, how to measure it. There is a rebuttable presumption that an entity can reliably measure the fair value of an investment property on an ongoing basis. However, in exceptional cases, clear evidence may arise when an entity first acquires an investment property or when an existing property first becomes an investment property due to a change in use, that the fair value of the investment property cannot be reliably measured on a continuous basis. This situation occurs only when the market for comparable properties is inactive. Examples of this include few recent transactions, outdated price quotations, or observed transaction prices that suggest the seller was forced to sell. Additionally, alternative reliable methods of measuring fair value, such as discounted cash flow projections, may not be available in such cases. If an entity determines that the fair value of an investment property under construction cannot be reliably measured but expects that the fair value will become reliably measurable, once construction is complete, it should measure the investment property under construction at cost until either the fair value becomes reliably measurable or construction is completed, whichever occurs first. If the fair value of an investment property, other than one under construction, cannot be reliably measured on an ongoing basis, the entity should measure that property using the cost model. In IAS 16 for owned investment property, or in accordance with IFRS 16 for investment property held by a lessee as a right-of-use asset. The residual value of the investment property should be assumed to be zero, and the entity should continue applying IAS 16 or IFRS 16 until the investment property is disposed of. Once an entity becomes able to reliably measure the fair value of an investment property under construction that was previously measured at cost, it should measure the property at its fair value. Upon completion of construction, it is assumed that the fair value can be reliably measured. However, if this is not the case, the property should be accounted for using the cost model in accordance with IAS 16 for owned assets or IFRS 16 for investment property held by a lessee as a right-of-use asset. The assumption that the fair value of investment property under construction can be reliably measured can only be rebutted at the time of initial recognition. If an entity has measured an investment property under construction at fair value, it should not later conclude that the fair value of the completed property cannot be reliably measured. In exceptional cases where an entity is required to measure an investment property using the cost model in accordance with IAS 16 or IFRS 16, as explained in paragraph 53, it must continue to measure all other investment properties, including investment property under construction, at fair value. Even though one investment property may be measured using the cost model, the entity should apply the fair value model to all other properties. If an entity has previously measured an investment property at fair value, it should continue measuring the property at fair value until it is disposed of or until it becomes owner-occupied or is developed for subsequent sale in the normal course of business, even if comparable market transactions become less frequent or market prices are harder to obtain. After initial recognition, an entity that selects the cost model will measure its investment property as follows. In accordance with IFRS 5 for non-current assets held for sale and discontinued operations, if the property meets the criteria to be classified as held for sale or is part of a disposal group classified as held for sale. In accordance with IFRS 16, if the property is held by a lessee as a right-of-use asset and is not held for sale under IFRS 5. In accordance with the requirements of IAS 16 for the cost model in all other instances. An entity must transfer a property to or from investment property only when there is a change in use. A change in use occurs when the property either meets or no longer meets the definition of investment property, and there is evidence of the change. A change in management's intentions regarding the use of a property alone does not demonstrate a change in use. Examples of evidence of a change in use include the start of owner-occupation or development aimed at owner-occupation, which leads to a transfer from investment property to owner-occupied property. The commencement of development intended for sale, which results in a transfer from investment property to inventories. The end of owner-occupation, resulting in a transfer from owner-occupied property to investment property. The initiation of an operating lease to another party, leading to a transfer from inventories to investment property. When an entity decides to dispose of an investment property without development, it continues to treat the property as investment property until it is derecognized, meaning it is eliminated from the statement of financial position and does not reclassify it as inventory. Similarly, if an entity begins redeveloping an existing investment property for future use as investment property, the property remains classified as investment property and is not reclassified as owner-occupied property during the redevelopment process. When using the cost model, transfers between investment property, owner-occupied property, and inventories do not affect the carrying amount of the transferred property, nor do they change the cost of the property for measurement or disclosure purposes. When an investment property carried at fair value is transferred to owner-occupied property or inventories, the property's deemed cost for subsequent accounting in accordance with IAS 16, IFRS 16, or IAS 2 is its fair value at the date of the change in use. If an owner-occupied property becomes an investment property that will be carried at fair value, the entity applies IAS 16 for owned property and IFRS 16 for property held by a lessee as a right-of-use asset up to the date of the change in use. The entity then treats any difference between the carrying amount of the property in accordance with IAS 16 or IFRS 16 and its fair value at that date in the same way as a revaluation under IAS 16. Until the date when an owner-occupied property becomes an investment property carried at fair value, the entity depreciates the property or the right-of-use asset and recognizes any impairment losses that have occurred. The difference at that date between the carrying amount of the property under IAS 16 or IFRS 16 and its fair value is treated like a revaluation under IAS 16. Specifically, any decrease in the carrying amount is recognized in profit or loss, except where an amount is included in the revaluation surplus for that property. In this case, the decrease is recognized in other comprehensive income and reduces the revaluation surplus within equity. Any resulting increase in the carrying amount is handled as follows. To the extent that the increase reverses a previous impairment loss for that property, the increase is recognized in profit or loss. However, the amount recognized in profit or loss cannot exceed the amount needed to restore the carrying amount to what it would have been had no impairment loss been recognized. Any remaining part of the increase is recognized in other comprehensive income and increases the revaluation surplus in equity. When the investment property is subsequently disposed of, the revaluation surplus included in equity may be transferred to retained earnings. This transfer from the revaluation surplus to retained earnings is not made through profit or loss. When a property is transferred from inventories to investment property that will be carried at fair value, any difference between the fair value at that date and its previous carrying amount must be recognized in profit or loss. This treatment is consistent with how sales of inventories are handled. Similarly, when an entity completes the construction or development of a self-constructed investment property that will be carried at fair value, any difference between the fair value at that point and its previous carrying amount should also be recognized in profit or loss. An investment property is derecognized or removed from the statement of financial position when it is disposed of or permanently withdrawn from use, provided that no future economic benefits are expected from its disposal. Disposal of an investment property can occur either through a sale or by entering into a finance lease. For a property that is sold, the date of disposal is when the recipient gains control of the investment property, as defined by the criteria in IFRS 15 for determining when a performance obligation is satisfied. IFRS 16 applies to disposals made through entering into a finance lease or through a sale and leaseback arrangement. When an entity recognizes the cost of replacing part of an investment property, in line with the recognition principle, it must derecognize the carrying amount of the replaced part. For investment properties measured using the cost model, the replaced part is not one that was separately depreciated. If it is not feasible for the entity to determine the carrying amount of the replaced part, it can use the cost of the replacement as an approximation of the cost of the replaced part when it was initially acquired or constructed. Under the fair value model, the fair value of an investment property may already reflect the loss of value of the part that is to be replaced. However, in some cases, it may be difficult to determine how much to reduce the fair value for the part being replaced. If it's not practical to adjust the fair value for the replaced part, an alternative approach is to include the cost of the replacement in the carrying amount of the asset and then reassess the fair value, as would be required for any additions that don't involve replacement. Gains or losses from the retirement or disposal of investment property are determined by the difference between the net disposal proceeds and the carrying amount of the asset. These gains or losses are recognized in profit or loss during the period in which the retirement or disposal occurs, unless IFRS 16 specifies otherwise in the case of a sale and leaseback. The amount of consideration included in the gain or loss from the derecognition of an investment property is determined based on the requirements for transaction price in IFRS 15, specifically paragraphs 47-72. Any subsequent changes to the estimated amount of the consideration are accounted for in line with the requirements for changes in the transaction price under IFRS 15. An entity applies IAS 37 or other relevant standards to any liabilities it retains after the disposal of an investment property. Compensation received from third parties for investment property that has been impaired, lost, or given up is recognized in profit or loss when the compensation becomes receivable. When it comes to investment property, there are a few important events to recognize separately. First, impairments are recorded according to IAS 36. If the property is retired or disposed of, we follow the specific rules in paragraphs 66 to 71 of the standard. Next, if there is compensation from third parties due to the property being impaired, lost, or given up, it's recognized in profit or loss when it becomes receivable. Lastly, for replacement assets, the cost is determined based on the guidelines in paragraphs 20 to 29 of the standard. Each of these steps is handled as a separate event and treated accordingly. For disclosure purposes, an entity must provide information beyond what is required by IFRS 16. According to IFRS 16, the owner of an investment property must include disclosures about the leases they have entered into, while a lessee who holds an investment property as a right-of-use asset must provide disclosures both for lessees and lessors when applicable. The entity should disclose whether it uses the fair value model or the cost model for its investment property. If classification between investment property, owner-occupied property, and property held for sale is difficult, the entity must explain the criteria it uses to distinguish these categories. Furthermore, the entity must disclose how much of the fair value of the investment property is based on a valuation from an independent valuer who has the appropriate professional qualifications and recent experience in the property's location and category. If no such valuation has been performed, that fact should be made clear. Additional disclosures include the amounts recognized in profit or loss, such as rental income from investment property, operating expenses like repairs and maintenance for properties that generated rental income, and expenses for properties that did not generate rental income. The entity must also disclose the cumulative change in fair value recognized in profit or loss when transferring an investment property from a cost model pool to a fair value model pool. Moreover, the entity should disclose any restrictions on the realizability of the investment property or the remittance of income and disposal proceeds. Finally, any contractual obligations to purchase, construct, or develop investment property or for repairs, maintenance, or enhancements must also be disclosed. When applying the fair value model, in addition to the disclosures already required, an entity must also provide a reconciliation of the carrying amounts of investment property at both the beginning and the end of the period. This reconciliation should include several key items such as additions, which must be separated into those resulting from acquisitions and those arising from subsequent expenditure recognized in the asset's carrying amount. It should also include additions from acquisitions through business combinations, as well as any assets classified as held for sale or included in a disposal group classified as held for sale according to IFRS 5, alongside other disposals. The entity should disclose net gains or losses from fair value adjustments, as well as net exchange differences that arise when translating the financial statements into a different presentation currency or when translating a foreign operation into the presentation currency of the reporting entity. Transfers to and from inventories and owner-occupied property should be included in the reconciliation, along with any other changes. If a valuation of investment property is significantly adjusted for financial statement purposes, such as to avoid double counting assets or liabilities that are recognized separately, the entity must disclose a reconciliation between the obtained valuation and the adjusted valuation presented in the financial statements. This should separately show the total amount of any recognized lease liabilities that have been added back and any other significant adjustments made. In those exceptional situations where an entity uses the cost model, under IAS 16, or measures investment property in line with IFRS 16, the reconciliation of investment property values should clearly separate the amounts related to these properties from those measured using the fair value model. In such cases, the entity also needs to disclose a description of the investment property in question, along with an explanation as to why fair value cannot be measured reliably. If it's possible, the entity should provide a range of estimates that represent where the fair value is most likely to fall. Furthermore, if the investment property that is not carried at fair value is eventually disposed of, the entity must disclose the fact that it has been sold, the carrying amount at the time of the sale, and the gain or loss that was recognized as a result. When an entity applies the cost model to its investment property, in addition to the general disclosure requirements, it must provide specific details about how it accounts for these assets. This includes the depreciation methods used and the useful lives or depreciation rates that have been applied. The entity should also disclose the gross carrying amount and the accumulated depreciation, which includes any accumulated impairment losses both at the beginning and at the end of the reporting period. A reconciliation is also required, showing the movement in the carrying amount of investment property over the period. This should include additions separating those that result from acquisitions from those that come from subsequent expenditure recognized as an asset. It should also note additions from business combinations. Net exchange differences from translating financial statements into a different presentation currency or when translating a foreign operation into the reporting entity's currency transfers to and from inventories and owner-occupied property, as well as other relevant changes. Assets that have been classified as held for sale or included in a disposal group must be identified alongside any disposals. The disclosure must cover the depreciation expense for the period, as well as any impairment losses recognized or reversed during the period in line with impairment standards. Lastly, even when using the cost model, the fair value of investment property must be disclosed. If, in rare cases, fair value cannot be measured reliably, the entity is expected to describe the property in question, explain why a reliable fair value cannot be determined, and, if feasible, provide a range of estimates within which that fair value is most likely to fall. When an entity that has already applied the earlier version of IAS 40 decides for the first time to classify and account for certain qualifying property interests held under operating leases as investment property, it must reflect the impact of that decision by adjusting the opening balance of retained earnings for the period in which the decision is made. This transition acknowledges the shift in accounting treatment under the fair value model. If the entity had previously disclosed the fair value of those property interests in earlier periods, and that valuation aligns with the fair value definition under the current standard, it is encouraged, though not required, to adjust the opening balance of retained earnings for the earliest comparative period where such fair value was made public. It is also encouraged to restate the comparative information for those earlier periods. On the other hand, if such fair value information was not previously disclosed publicly, then the entity should not restate the comparative periods, and it must clearly disclose this fact. This transition approach differs from what is generally required under accounting change rules, which typically mandate restatement of comparatives unless that is impracticable. Lastly, at the time of first applying the standard, the adjustment to retained earnings should also include any amount previously held in a revaluation surplus related to the investment property being reclassified. When an entity first applies this standard and opts to use the cost model, any change in accounting policies must follow the guidance provided by IAS 8. This means that the impact of adopting the cost model, including the reclassification of any balance previously held in the revaluation surplus related to investment property, must be accounted for in line with IAS 8's principles for changes in accounting policies. Additionally, the rules outlined for the initial measurement of investment property acquired through the exchange of assets, specifically those found in the relevant section of the standard, are to be applied only to transactions occurring after the date of initial application. In other words, these measurement rules are not retroactive and should only be used for future exchanges. The amendment introduced through the Annual Improvement Cycle 2011-2013, issued in December 2013, brought a new provision that must be applied prospectively. This means that from the start of the first reporting period in which the amendment is adopted, an entity must follow the updated guidance for any new acquisitions of investment property. It is important to note that this change does not require adjustments to how acquisitions were accounted for in previous periods. However, if an entity has access to the necessary information, it may choose to apply the amendment to earlier acquisitions that occurred before the effective date. This is entirely optional and only allowed if the relevant data for those past transactions is available. When an entity applies IFRS 16 and the related amendments to the standard for the first time, it must follow the transition requirements outlined in Appendix C of IFRS 16. These requirements apply specifically to investment property that is held as a right-of-use asset. This ensures that the transition to the new standard is handled consistently and in line with the specified guidance. The amendments to the section on transfers of investment property, issued in December 2016, require entities to apply the updated guidance to any changes in use that occur on or after the start of the annual reporting period when the amendments are first applied. This means that at the initial date of application, the entity must reassess how it classifies any property it holds at that time. If necessary, it should reclassify the property based on the existing conditions using the relevant criteria. Although the general rule is to apply the amendments from the date of initial application, an entity may choose to apply them retrospectively in line with IAS 8, but only if doing so does not involve the use of hindsight. The amendments to the section on transfers of investment property, issued in December 2016, specify that entities must apply the updated guidance to any changes in use that happen on or after the beginning of the annual reporting period in which the amendments are first applied. On the date of initial application, the entity must reassess the classification of any property it holds. If necessary, the property should be reclassified according to the conditions at that time, using the appropriate criteria. Although the amendments generally apply from the date of initial application, an entity has the option to apply them retrospectively, in accordance with IAS 8, as long as doing so does not involve hindsight. An entity is required to apply this standard for annual periods starting on or after January 1, 2005, with earlier application being encouraged. If the entity applies this standard for a period beginning before January 1, 2005, it must disclose that fact. In addition, IAS 1 presentation of financial statements, as revised in 2007, updated the terminology used throughout IFRSs and amended paragraph 62. These amendments should be applied for annual periods starting on or after January 1, 2009. If an entity applies the revised IAS 1 for an earlier period, it must apply the amendments for that period as well. Paragraphs 8, 9, 48, 53, 54, and 57 were amended. Paragraph 22 was deleted, and paragraphs 53A and 53B were added through the improvements to IFRSs issued in May 2008. Entities must apply these amendments prospectively for annual periods starting on or after January 1, 2009. However, an entity may choose to apply these amendments to investment property under construction from any date before January 1, 2009, as long as the fair values of investment properties under construction were measured at those dates. Earlier application is allowed, and if an entity applies the amendments for an earlier period, it must disclose that fact and also apply the amendments to paragraphs 5 and 81E of IAS 16, Property, Plant, and Equipment. IFRS 13, issued in May 2011, amended the definition of fair value in paragraph 5 and made changes to paragraphs 26, 29, 32, 40, 48, 53, 53B, 78, 80, and 85B. It also deleted paragraphs 36, 39, 42, 47, 49, 51, and 75D. Entities must apply these amendments when they apply IFRS 13. The Annual Improvement Cycle 2011-2013, issued in December 2013, added headings before paragraph 6 and after paragraph 84, and included new paragraphs 14A and 84A. These amendments are effective for annual periods beginning on or after July 1, 2014. Earlier application is allowed, and if an entity applies the amendments for an earlier period, it must disclose that fact. IFRS 15, issued in May 2014, made amendments to paragraphs 3B, 9, 67, and 70. Entities must apply these amendments when they apply IFRS 15. IFRS 16, issued in January 2016, amended the scope of IAS 40 by defining investment property to include both owned investment property and property held by a lessee as a right-of-use asset. IFRS 16 amended multiple paragraphs of IAS 40, including paragraphs 5, 7, 8, 9, 16, 20, 30, 41, 50, 53, 53A, 54, 56, 60, 61, 62, 67, 69, 74, 75, 77, and 78. It also added paragraphs 19A, 29A, 40A, and 84B, along with their respective headings, and deleted paragraphs 3, 6, 25, 26, and 34. These amendments should be applied when IFRS 16 is adopted. The amendments to IAS 40 regarding transfers of investment property, issued in December 2016, modified paragraphs 57, 58, and added paragraphs 84C, 84E. These amendments should be applied for annual periods beginning on or after the 1st of January 2018. Earlier application is permitted, and if an entity applies these amendments for an earlier period, it must disclose that fact. IFRS 17, issued in May 2017, amended paragraph 32B. An entity should apply this amendment when it adopts IFRS 17. The issuance of the updated IAS 40 supersedes the previous version of IAS 40, which was issued in 2000. The new version incorporates various amendments and updates, ensuring alignment with current accounting standards and practices. This withdrawal of the 2000 version marks the transition to the revised guidelines, which include significant changes in accounting for investment properties, such as the introduction of fair value models and adjustments to the classification of property. The revised version of IAS 40, Investment Property, issued in December 2003, was approved by the International Accounting Standards Board, IASB. The 14 members of the IASB who approved the standard at that time included Sir David Tweedy, Thomas E. Jones, Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gallard, James J. Leisenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmid, John T. Smith, Jeffrey Whittington, Tatsumi Yamada. These members collectively contributed to the development and approval of the updated standard, which provided clarity and improvements in accounting for investment properties. The amendments to IAS 40, Transfers of Investment Property, issued in December 2016, were approved for issue by all 12 members of the International Accounting Standards Board, IASB. The members who approved these amendments were Hans Hugervorst, Suzanne Lloyd, Stephen Cooper, Philippe Danjou, Martin Edelman, Amaro Gomez, Gary Kabarek, Takatsugu Ochi, Daryl Scott, Chung Woo-sir, Mary Takar, Weiguo Zhang. These amendments provided further clarification on how to account for transfers of investment property, including changes in use and reclassification of property under certain conditions. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qllever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.